Hello, welcome to Opalesque TV. My name is Matthias Knab. I started this channel way back in 2003 when I started the first digital newsletter on hedge funds. And with the videos, we started in 2009. Today, we have a very special guest, Tom Zucosky. I have known Tom for about 20 years. He's a dear friend, and he has been in hedge funds, not 20 or 22 years like me, but, add another 20 years. So we are going to talk about some really interesting things, so stay tuned. But before we start, let me allow Tom to tell us, how did you get started in finance? Because that was actually at a very interesting time where a lot of things happened that today we take for granted. So Tom, tell us the story.
Well, first of all, thank you for inviting me. I really appreciate the opportunity. I started on Wall Street, believe it or not, in 1981. And Wall Street was a dead-end career in 1981 because we were at the end of this very long malaise from the mid-'70s and then eventually an actual recession in 81 that ended in August of 82 under Ronald Reagan. But it was also a time of very interesting financial engineering. The creation of index futures, financial futures, futures on Ginnie Maes and T-bills, futures on the S&P 500, and then options on those futures. So it was really interesting. And people that were in the futures industry at the time and who had their experience, their whole experience was in pork bellies and wheat and corn and things like that, didn't really know what to do with that. So here I am at 24 years old at Shearson American Express, on the 104th floor of Two World Trade Center, where the futures division was. And our boss said, who's going to be in charge of these, financial futures and figure out what to do with them for our clients? And thinking of my father, who always used to say, when somebody asks you if you can do something, the answer is always yes, and then go figure out how to do it. So I raised my hand and said, I'll be the guy. And then I figured out, studied on financial futures. And eventually we were working with the American Express corporate clients and banks and savings and loans to create various structures to asset liability hedge and various types of mostly hedging. But then eventually I became disillusioned with the sell side at Shearson and went to the buy side as a registered investment advisor. And then eventually with two other partners created my own hedge fund, Aegis Capital, in 1985 at the ripe age of 29 years old. And we did some very interesting things. We were doing program trading, equity market neutral, dividend capture, futures trading. And it was an exciting time. Then, because of the implied volatilities in these instruments, I used to say you could drive a truck through these spreads. And so it was like the proverbial taking candy from a baby. It was really easy to make money, and it was, the salad days of these instruments and the trading that we would do. But eventually, I started to have a family and didn't want to raise my kids in Manhattan, so we moved to Princeton, New Jersey, and was working with a splinter group that came out of Commodities Corporation, eventually Goldman Sachs Asset Management. That's when I started to advise clients about hedge funds as opposed to being a hedge fund manager. One of my clients was Olympia Capital out of Paris, Mark Landau. So Mark Landau approached me at a lunch in New York City and asked if I would be the head of his due diligence for Olympia Capital, operating out of New York City. And that's what I did. So we had a fund called the STARS Fund. And the STARS Fund meant that we had money with every one of the big managers. So in the mid-1990s, I was interacting with and monitoring and allocating capital to the who's who of the hedge fund community in those days. And you could just think of the names: George Soros, Julian Robertson, Michael Steinhardt, Bruce Kovner, Stevie Cohen, Ken Griffin, Paul Tudor Jones, Monroe Trout, Louis Bacon, Leon Cooperman. These are all people who I interviewed, spent time with some of them I got to know really well. And then when you had difficult times like we did in February of 1982, when the Fed had raised interest rates without announcing them, since then the Fed has learned to, tip its hand a little bit to the markets before it does anything. But Alan Greenspan in February of 1992 raised rates, surprised everyone, and here I am dealing with the Leon Coopermans of the world and the Louis Bacons of the world, and figuring out, is this the opportunity to invest low because they're going to come back, or is this the beginning of the end for these managers? And it was a very difficult time. But that was, what I was doing back in the 1990s.
Let me stop you here, right? Because you mentioned Mark Landau, Olympia Capital. And, people may be familiar with all the big hedge fund names that you mentioned, but that period was also, let's call it the golden age of the hedge fund of funds, right? And Olympia Capital was at that time, one of the biggest, most established hedge fund of funds. So tell me, who invested in hedge funds back then, right? In the 90s, that period until, let's say, the early 2000s. Who invested in hedge funds, right? And why did they buy hedge funds back then?
It has evolved over time. So today it's very different than it was back then. Back then it was mostly individuals or clients of private banks. So the Geneva-based private banks would introduce these funds of funds to their investors and have investments. And Mark Landau used to say to me, I feel like I'm a concierge. I'm introducing these investors to George Soros and Julian Robertson. So it was really if you invest in IBM, no one can blame you because you invested at the time in the largest and best known company in the stock exchange. Same thing with George Soros and Julian Robertson. No one's going to fire you because you recommended Julian Robertson to them or Michael Steinhardt.
Tom, it was also an access game, right? Because access to Soros and Julian Robertson, they were all kind of flying under the radar. They probably didn't have the massive investor relations team as hedge funds have today, right? Or the big multi-strats have today. So it was a different game. And accessing hedge funds, you had to go through a bottleneck and maybe personal relationships to actually hear about them, etc. So just give us a bit of a feel. How was it back then? How did people know about hedge funds? Did you mention the Geneva banks, right? What else? Did people buy hedge funds in the US at all?
Yes, they did. They would invest into limited partnerships in the United States, but these are individuals. Institutions were not investing in hedge funds at that time. And back then, and this is before Bernie Madoff, the limited partnerships would do their own fund administration, right? So then, it became the necessity to have a third-party independent administrator. But the investors were generally individuals doing relatively small amounts. Maybe if it was a wealthy family at a private Swiss bank, it would be larger investments, but they were still individuals or groups of individuals. And it was, an introduction game. You had to deal with a lot of, hey, if I get you into George Soros, if I get you into Caxton, if I introduce you to these people, there's got to be a kickback to me. There's got to be some financial remuneration for me. And it really was like you were keeping all your contacts close to the vest. And so everyone had their database of managers, and this was really a big deal. I'm glad you asked this question, because people would never share names of managers with each other. And one of the things I pride myself on is being able to see, beyond the horizon to what the future is. And when the internet came around, I'm like, this blows everything away. Now everything is known, and it's not the, the who do you know, but it's what do you know, and what do you know about these strategies. So it really became a matter of really understanding the strategies. Because let's be clear, back in the 80s and 90s, these private banks did not understand these strategies. They just trusted that they weren't going to blow up because they gave money to George Soros.
Another thing we also have to mention in this discussion, that hedge funds back then, number one, there were way fewer, and number two, they were way smaller, right? That's also important to notice, and therefore they had a different return profile, right? So let's talk about how has the return profile, the alpha generation, changed, right? How was it back then, and how is it today, and what was driving the alpha generation back then, and how do you see the hedge funds performing today when it comes to alpha and outperformance?
Back then, there were basically two kinds of hedge funds. You were very aggressive, and you had a lot of volatility, a low Sharpe ratio, or you were going for very low volatility and just getting a 10, 12% return. And the issue was, yes, those returns were available without the use of leverage because of, as I said before, of these implied volatilities, but they didn't want to scare investors. So they tried to produce a consistent rate of return, which is what eventually led to the phenomenon of Bernie Madoff. And that consistency really lulled people into a sense of security and eventually, blew up. But the interesting thing is that they became these small funds, as you say correctly. If you look at Paul Tudor Jones was a cotton trader, right? Ken Griffin was a bond trader. But once they became popular and assets flowed to these well-known managers, their assets grew tremendously. And what that meant was they had to drift, the term style drift. They drifted away from their core competency of trading cotton, let's say. So that in 1987, Paul Tudor Jones called the crash of 1987. That's not a cotton trade. He evolved from cotton trading. Same thing with Soros and everybody else. They were doing something else, and then they got into global macro. Global macro is the last resting place for managers as they grow their assets. And what we worry about as allocators, professional allocators, is when managers go from a incentive fee type of business to a management fee type of business. So they're just collecting assets and they don't want to blow up. So they're just trying to be careful and not be too aggressive so they can keep the assets and take in their management fees, as opposed to when they're smaller and younger, they're more aggressive and they're looking for an incentive fee, a profit, a piece of the profits. What I want to rotate out of a manager once they're in that management fee side of the business.
Tom, how do you recognize that when the manager is shifting?
Well, there's several. I mean, a joke in the industry is when you see that the manager has a private plane or has their second Lamborghini or something like that, then that's the telltale sign. That's a joke. But the other thing is when they are taking on, when you've spoken to a manager, when you first knew them. I mean, I knew Stevie Cohen, he had $50 million under management. I knew Ken Griffin when he had less than $50 million under management. All right. So, and I'm not talking about them in particular, but if someone says to you, my capacity is $250 million, I can't do what I do, the alpha goes away above $250 million. And then one day you look and now they're at $1 billion or $2 billion or more. And you're like, well, what happened? Now, sometimes there's a good answer to that. They hired people that do the same thing that is their core competency. And so they're stuck to their knitting, but they've got, 6 or 7 or 8 guys doing the same thing. So that's a reasonable explanation. But The other thing is that what you look for is this style drift. We're moving away from their core competency. Now they're talking about South American bonds, and they're talking about the dollar yen trade or something like that. And then the other interesting thing was how the global macro was something that in the 90s, as I said before, with the Steinhardts and the Coopermans and other people, they became macro managers. And back in the day, George Soros could pay for feet on the ground in Brazil, for people to see what's going on in Brazil, in the cities of Brazil, and then report back, and he could put a trade on so that when everybody else discovered what was going on in Brazil or wherever else, he was getting out of the trade when everybody else was getting in. The internet leveled that playing field because now all the information was available to everybody at the same time. That information arbitrage that George Soros and others like him were pulling off in the late 90s went away. And if you look at it, global macro went away for a while. For a number of years, there were no global macro managers because they couldn't figure out how to create returns that weren't that information arbitrage. Now it's come back, and there are other reasons because you've got technology, AI, and other ways to take advantage of these opportunities. I started Discovery Capital in partnership with Oscar Lanowski, who was in the fund administration side of Olympia Capital. And originally, I created Discovery to consult with institutions about hedge funds, to help institutions figure out how to invest in hedge funds. So this was the late 1990s, early 2000s, and it was the institutionalization of hedge funds. And I was lucky enough to be consulting with CalPERS and ABP and Citigroup Pension Fund and the World Bank and other institutions. And as they were trying to figure out how should they and how would they access alpha, right? Because they understand beta, but they didn't understand alpha and how to access it. And there were other things like portable alpha, which I'm not a big fan of, but we can talk. That's for another discussion. And so I was working with these institutions in making decisions about. And I remember I was speaking at a conference one time with the CIO of CalPERS, and he made the joke that the institutionalization of hedge funds hopefully doesn't mean that hedge fund managers are going to prison. And of course, we know that some of them actually did. And I'm not a big fan as an allocator of the institutionalization of hedge funds because what they care most about are fees. And so that became the whole big thing about the squashing of fees. And I would always say to my institutional clients, if you get, let's talk about, somebody that people would know like a Michael Jordan or a Messi. If they are truly the best at what they do, they're not going to give away their capacity, their limited capacity in alpha production for a lower fee. The best are always going to be able to command the highest rates. Look at you look at any sport, look at racing or anything. The best of the best are not taking less salary, less fees. They're getting more because everyone's clamoring to be with the best. And that's really I would speak at conferences about alpha. If you're let's say in baseball, right? The average baseball player hits around 225, 230, which means that they strike out or make an out 3/4 of the time. They're only successful 1/4 of the time. But then you get a guy like Ted Williams, or so far this year, Aaron Judge for the New York Yankees. Ted Williams batted 400 for an entire season, meaning that he was successful 40% of the time. Still not 50% or more than 50%, but the difference between being successful 25% and being successful 40% is alpha, right? That is skill. That's something you can't define by the average. So if beta is the stock market and the stock market is up 1%, but your manager is up 2%, then you can explain 1% of their return by the beta of the market. But there's 1% you can't explain by the beta of the market, and that is skill. And that's what I look for. I look for, having been a hedge fund manager, having created these strategies and marketed these strategies to institutions and traded these strategies, I look for that ethereal thing called alpha, skill. The problem that getting back to the institutionalization of hedge funds is that institutions, and this is where I really have a problem with the way institutions look at alpha, because of their mindset, because of the way they see the world, alpha in their mind is something that you can add to a beta portfolio and juice it up. And I would speak at these conferences, and I was not a fan. I was not in favor, let's put it that way, with a lot of these institutions, because I would say alpha is not something that you go to the supermarket and grab some alpha off of the shelf and put it in your shopping cart. It's a very rare thing. And when you see it, you grab it. And the reason you grab it as quickly as you can is because alpha tends to be arbed out. If the alpha is because there's a dislocation in a marketplace, that there's a supply issue in, let's say oil or something, eventually everyone finds that out and they take away the opportunities, the spreads that were inherent in that dislocation. So alpha is a rare thing. It is not a commodity. And anybody who tells you that, you can take some alpha and sprinkle it onto your beta, and that's portable alpha, they don't really know about hedge funds. Previously, you would find someone who you liked, you understood what they were doing, and you gave them money. And by and large, you left them alone and looked at your statements, once or twice a year and were satisfied with the return. When hedge funds became professionalized, when people like me, made this their living, I look at the returns literally dynamically, throughout the day, over the course of the day, like 70 times a day. So there's no right way to invest in hedge funds. The right way is the way that works for you. You can have a paralysis by analysis by having too much information, and then you act too quickly. I've had institutions say to me, "Tom, you have all this information, all this transparency. I don't want that transparency, because if something happens and I don't act, and they know that I had the information, then I'm going to lose my job, because I knew I could see it happening and I didn't act on it." So that's why private equity has become so popular, because you can just blithely, forget about what's going on, and once a quarter or a couple times a year, see what the returns are. So the way you invest in hedge funds depends on your expertise, the amount of money that you have, what you're trying to accomplish. There's no one size fits all for investing in hedge funds. I mean, there's a lot of debate about, people, if I say to, college friends of mine, "Oh, Tom's in the hedge fund industry, that's very risky." It's sort of like saying that all restaurants are French restaurants, with high-end French cuisine. You can go from a hot dog stand on the street corner to, this gastro wonderland. Same thing with mutual funds. You can't say that all mutual funds are money market funds, even though a money market fund is a mutual fund, but there's also emerging market mutual funds, which are very volatile and very risky. So there is no one size fits all. And that's why when you look at a hedge fund index, it's not really helpful, because really all it's doing is taking the mean of a data set that's, a mile wide, and just giving you the middle point and saying that's what hedge funds did this month, or year. It's meaningless, completely meaningless.
Maybe this is also a good point now to basically explain people, how do you invest in hedge funds today, right? And continue from there.
So now funds of funds have more or less gone the way of the dodo bird. There are very few of them anymore because they saw these layering of fees that a lot of the funds of funds the managers of the funds of funds were really glorified marketing people. They really didn't know what they were investing with, and in some cases, like this concierge sort of concept. And what evolved from that was the pods, these platforms. So you have the Millenniums and Citadel and others like that, where they're multi-strategy hedge funds. So they're single entities, but it's like a fund of funds in the sense they have multiple trading teams, but those trading teams are employees of the firm, and they make their allocations to their different teams within the organization. Getting back to your earlier question, what has happened is those big spreads that I started with back in the early 1980s have gone away. They've been arbed out. The way that these multi-strat funds make money these days is they realize there's not a lot of juice, right, in these trades. So what they do is they find experts, teams of experts, these really smart guys have been doing this a long time. They bring the team in, they give them a boatload of money, $500 million, which is in most cases is more than they should be trading in that strategy, which is another conversation. And then because there's not a lot of return in the strategy, the way they get the return is through leverage. The way they manage the leverage is what is important. So they have very tight risk controls, and it's a lot of people burn out in these platforms because they've got not a lot of wiggle room. They could say, "Why did you fire me? I was only down 1%. Well, yeah, you think you were down 1%, but in our books you were down 10% because of the leverage that we use. So that is sort of the hedge fund investing 2 or 3, if you will, 0.0. And everyone felt, again, back to that comfort factor. In the old days, it was comfort because there was a certain amount of panache that was associated with being invested with George Soros or Julian Robertson or whomever. Now you've got these very large, tens and tens and tens of billions of dollars of assets under management, multi-strategy platforms that produce a regular kind of 10, 12, 9, 14% return. What we have to understand about these things is a few things. One is there's a lot of leverage in there. So if you took out the leverage, the actual returns are just a couple of percent. Also the fees. A lot of these platforms will charge a pass-through. So they're literally charging the investor whatever the document says they can do is what they do. But I mean, it can be rent, it can be the salaries for the traders, it could be all of the marketing, it could be the technology. It is not unusual for, and I'm not going to mention any names, but it's not unusual for a platform to literally have a hurdle of low double digits before the investor makes any money at all. So that is where we have been. And if you talk to my friends in the multi-strat platform pod business, they'll say that it's been like a Hunger Games. It's where the industry has kind of cannibalized itself. It's eating itself because all this money is being thrown at the best and the brightest. When somebody leaves Goldman or somebody leaves Millennium to form their own hedge fund, all of a sudden they're like, okay, we'll write you a check for $1 billion. And then the other platforms are looking at them and going like, well, I can't compete with $1 billion. I can only give you 100 million. I joined forces with First New York Securities in 2008. 2008, as we all know, was a real watershed year in finance, in the economy, in hedge funds. And having been in the business since the early 1980s and all that evolution that we've talked about in this discussion today, when we got to 2008, I got religion on two things. One is I was never going to invest in a commingled vehicle again as long as I live, because I never wanted to have that phone call again like I did in 2008, where you say to someone, hey, I got to get out of this, my investment with you. And they say, well, we're putting up the gates. No, we're not letting anybody out. So now you've got redemptions and you can't get money out of these funds. And now you start doing things like side pockets and giving people, exposure to an illiquid share of a fund. What happened in 2008 is there were some of these managers, Warren Buffett is famous for saying, when the tide goes out, you know who's been wearing a bathing suit and who has not been wearing a bathing suit. And in 2008, what was going on is, because of what we've talked about as far as the this macro approach to trading, people had these illiquid investments, and they had subscriptions coming in, and they used the subscriptions to pay the redemptions, but they didn't sell the core illiquid book of their portfolio. Now, 2008 happens, and the subscriptions go away, but the redemptions continue and ramp up. So now they say, damn, I can't meet these redemptions. I have no subscriptions coming in, and I can't sell my illiquid stuff. And now everyone's going to know that I haven't been wearing a bathing suit this whole time. That's how I've been getting my returns, through illiquid stuff. And people put up the gates. And some of them, who have tens of billions of dollars under management today, survived because they put up the gates. But it wasn't, if they hadn't or they couldn't, they would have been out of business by now. So in 2008, I joined forces, as I said, with First New York Securities, and I was tasked with outsourcing balance sheet to traders who would normally be hired to sit on the trading desk, but they already had their own identity as a hedge fund. So we would outsource balance sheet to them through a separately managed account. So we replicated the trading desk experience with these traders in even a better way, because we didn't have to pay them any salary. We didn't have to give them real estate. We didn't have to give them technology. We didn't have to give them healthcare. We didn't have to pay a management fee like a fund of funds would. And we could see the positions real time and communicate with the managers about the risk, the returns, the opportunities, the challenges. And so that's when I pivoted and created the what is today the Lucidity model. So getting back, there's a long-winded way of answering your question, Matthias, I'm sorry. The way we invest today is we're kind of a virtual prop trading shop, in the sense that I kind of sit at the head of this virtual trading desk, and I've got a equity market neutral manager, and I've got an event-driven manager, and I've got a short-term futures trader, and I've got a crypto manager. All of these different strategies, 24 strategies, and every one of them has a investment management agreement. Okay, so we are not giving them money. We are giving them a limited power of attorney that enables them to trade only what is listed in the investment management agreement. So if they are a technology manager and they try to put on an oil company stock, it's not going to allow it. So we that's one of the ways that we control risk. What I say, as far as our motto, if you will, at Lucidity is TLC, right? Transparency, liquidity, control. I've had money with Izzy Englander at Millennium, and if you go, or these days you really can't. But back in the day, I mean, I had money with Izzy Englander in 1994. I would go into a meeting with Izzy Englander and sit there and have a lovely conversation for 45 minutes, an hour. And you would leave and you'd say, that was a lovely conversation, but you know what? He didn't tell me anything about what's in the portfolio, what they're actually doing. So this lack, the hedge funds are notorious for being black boxes, for not being transparent about what they own. I remember at a conference I was speaking at one time, there was a head of a major pension fund. I forget which it was, but it was a major pension fund. And this is at the beginning of the institutionalization of hedge funds. And the guy said, let me tell you in my mind what a hedge fund is. A hedge fund is you take a bag of money and you go into a forest and you put the bag of money on a tree stump and you go and you leave and you come back in a year and you hope that it's still there and that it's grown and multiplied. That was what he said at a conference about what is a hedge fund for him. And what that means is there's this complete lack of transparency about how these hedge funds make money. So getting back to your question, how do we differentiate ourselves? We're completely transparent. The name of the company is Lucidity. Lucidity means two things. One is it's transparent, and it means it's liquid. One of the things that we do that other people can't or won't do is for $10 million, a family or wealthy investor, whatever, could open an account at Goldman Sachs in their name, and we would build a bespoke portfolio for them. No other co-investors. This is only their portfolio in their name. They can see every position, and they know that no one can run away with the money because it's in their name. The only people that can move anything, I can't. The only person who can move anything is the investor. So getting back to the TLC. So what we do is completely transparent. That's not something other hedge funds or multi-strat platforms are going to give you. Transparency into the positions. Liquidity. It's the weekend, but on Monday, I could sell 90% of the portfolio within the trading day on Monday. We could be 90% in cash within one trading day. Everything is very liquid, exchange traded. It's low net exposure, hedged, not very levered. So there are no private equity positions, no real estate positions, no pipes, no emerging markets, nothing that would take, no bonds. In the bond market, you have to call and negotiate the sale price. We want to be able to push a button and get out. So liquidity. And then control is we're not sending money to a commingled vehicle. Either we or the investor controls the assets. So that transparency, liquidity, control. I managed money for family offices for many years, and the family office would sit with me at an investor meeting and say, Tom cannot promise me that he's going to make me money, but there's three things that we know. One, we know what we own, transparency. Two, we know we can get the hell out, liquidity. And three, we know that nobody can run away with the money, control. That's what we offer. Plus we've got somebody that, sitting in the driver's seat that's been doing this, that has traded, been a hedge fund manager, has interviewed thousands of managers, and some are the brightest minds in finance, including Warren Buffett, by the way, ever in finance. And so hopefully we differentiate ourselves in that the people that are associated with our firm are senior statesmen of the industry. They've been doing it for a long time. Their reputations matter a lot to them. We have a structure whereby the investor knows that there's liquidity, there's transparency, the control of the assets. He knows that we're allocating only to very liquid but alpha-driven strategies. These are guys that used to be at wherever, and now they're sitting at home and they're trading $10, $20, $30 million of friends and family money. It's difficult to raise money. We show up with a $5, $10, $20 million managed account, And now we see ourselves as a strategic partner. I think a lot of these allocators have an adversarial relationship with the managers, but because of who we are and where I've been in my career, I want to be synergistic with the manager. I want to be the guy that says, you've been having a tough time. Why the reason they pay me the big bucks is to know whether this is the time that you should shut it down and go on vacation for a month, or this is the time to double down and go swing for the fences. And it's that experience and that relationship. This is, at the end of the day, this is a behavioral science business. There's a lot of math, there's a lot of AI, there's a lot of quantitative strategies, but at the end of the day, it's understanding the person sitting across from you and their relationship with fear and greed and how they have experienced that in the past. And you look at their track record and you say, okay, in this time frame, that strategy was really stressed. How did you do in that? And what was going on in your shop when that was happening? Who did what? How did you get out of it? Those conversations are what differentiate, I like to believe, differentiated us from our competitors. Big is bad in the production of alpha. If you're, in the old days, the hedge fund was the mouse that was running in and out of the feed of the elephants. Now these big hedge funds are the elephants. They are the market. So we want to go back to being the mice again. And we want to be small with very smart guys that have been doing this for a long time. We want to give them a separately managed account, so we're not investing in their commingled vehicle. We want to be able to see everything that's going on. And we want to have strategies that we understand where the alpha is coming from. We understand what the risks are, that we're familiar with it. So today, when we look at the strategies, we look at for things that we understand, that we think there is. The key is to have not only alpha, but sustainable alpha. If you look at somebody and they did well last year, is it just because the stars aligned and they had the right strategy for the right market? Or do you think that this is something that is replicable going forward into the future? So when we look at the portfolio today, people that we talk about 6 degrees of separation. We like to have 1 or 2 degrees of separation. That is, people we know really well, that we've known, over the years, or someone we know knows them very well and can speak to their character. And the strategies we look for have to be liquid. They have to be uncorrelated to the markets. They have to be uncorrelated one to the other. So we look at different types of asset classes. We're looking at large cap, small cap. We're looking at regional differences within the United States or maybe in Canada. We're looking at sector differences, maybe TMT, technology, media, or energy, or could be in nuclear energy versus traditional carbon. It could be in crypto, long, short. Could be various forms of arbitrage. Again, is that arbitrage sustainable and doable into the future? So at the end of the day, we've got, let's say, 30 managers with different strategies that we have in our bullpen. And when we put together a portfolio, whether it's a bespoke portfolio, if you look at our portfolio today, it's about 13 different managers and strategies. And then we solve for volatility, right? So the higher the Sharpe ratio, the lower the volatility, the larger the allocation. The higher the volatility, the lower the allocation. But then we have to look at what's the correlation amongst the managers. If you looked at a correlation matrix of our portfolio, the constituents of our portfolio today, none of them is highly correlated to one another or the markets. So the idea is to have all these different alpha sources that are really good risk managers. So when they're having a bad month, they manage the risk, and I'm overseeing that. I'm helping them understand what the tolerances are that we have. So they limit that downside, but when they're doing well, they're letting their profits run. And so you get this sort of stair step type of return characteristic where when we have a challenging period, we're, flat to down 1%, and we're having a really good period, we're maybe up 5 or 6 or 7% for that month.
So Tom, in your model, how do you find trading talent, right? How do you expand?
Well, there are a myriad number of ways for us to find trading talent. There are databases and there are conferences, reports that you can read. But that's really not the way we find. We do all those things because you really need to. But that's not really the way that we find trading talent. It's more often than not word of mouth. It's someone who knows us well, knows what our model is, knows what the type of managers that we're looking for, refers us to someone, or says, "Hey, we're about to invest with this manager, and it would be helpful if you could join in and be part of the investing pool that allocates to them." We're also, by the way, not averse to being first dollars. I went to a Goldman conference at Yankee Stadium about a month or so ago, and there were, I forget the exact number, but maybe like 75 managers there. And I would venture to guess that there were a half dozen who were managers that I was the first investor. That I had one manager, I won't mention their name, but they said in our, you have these breakout sections, all right? So you've got 10 or so investors sitting in this presentation. And this manager said, "I just want everybody to know that the reason we're here today, the reason we have $5 billion of assets under management is because of Tom. When no one would give us the time of day, he wrote us a check for $10 million. And we used to take managed accounts. We don't take managed accounts anymore because we have $5 billion. But there's one guy who, if he wanted a managed account, he's going to get one. And that's because he was there when no one else would give us money." And I'm proud to say that there were a number of those kinds of conversations at that Goldman conference a month ago. And so why is that? That is because we understand the strategies. We're able to discern whether this is a repeatable type of strategy. We have that 6 degrees of separation, so we're able to find people who know these people well and can vouch for their character and all of that. So that's what we do is we network with people. As I said before, it's behavioral science. It's sitting there. At the end of the day, you know what it is ultimately? I'm sitting across from you, the portfolio manager, and I'm asking you questions about the strategy and what are the challenges to your strategy and what periods or what kinds of markets are going to be a challenge for you. But ultimately, as you're talking, I'm sitting there and I've got this internal voice that says, "Oh my God, I've got to get money with this guy." Right? Because you're just sitting there going, "Holy mackerel, this guy really is something special." And that's, that I think we have that ability to make that discernment.
This is fascinating. So you explained to us all the different strategies, and that makes total sense. At the same time, I would think the way you work and from where you are coming from, that the managers you work with, that there's also, let's call it a common denominator, something they all have in common. It may be experience, it may be a characteristic, something of their character. What is that you are looking for? And that probably, this is suspicion, this is a thought I have, there are some qualities that these managers display, right? What is it?
Yeah, that's a great question. I think that gets to the nub of our business model, which is we're looking for, getting back to my earlier comment about arbitrage, we're looking for that arbitrage. We're looking for that very rare thing of a manager who has decades of maybe a decade or maybe decades of experience, but now this is their new iteration. They left the pod that they were working at, and now they're managing their own money, sitting in their living room. They only have 20 million or $30 million of assets under management. So they're very smart, they're very experienced, but they don't have a lot of assets under management. So they're willing to take a managed account. Okay, that's key. They're willing to take a managed account. The other thing is, I want that experience because I want someone who has gone through the trials and tribulations. All of us who have been in these markets for as long as I have, for 40 years, I can tell you without a doubt, I've got the scar tissue all over my body from the mistakes that I've made that I don't ever want to make again. And I want to find that manager. I want to find that guy or gal, let's say guy. I want to find that guy who made that mistake previously. And now he has tattooed on his forehead. And every morning when he goes to shave, it says, "Don't ever do that again." I like it when they've lost money on someone else's dime. And now I benefit from the learnings of that. They tend to be people who are risk averse. They tend to understand our model, which is, if I tap them on the shoulder and say, "Listen, man, this COVID thing, I don't know what's going on. Let's take the risk down." And they're already, "Yeah, I'm already there, boss. We're already got the risk down. We'll be, flat by the end of the day." So they're risk averse. They've been through the mill. There's a certain level of character. I want to have a relationship with someone. I don't want to have a relationship with a machine. I want to have a relationship with someone who programmed the machine or is the trader that I can talk to, that they can relate to. I want to have a relationship with that person. And if I can't trust that person, I don't have to like them, but I have to trust them. And I have to feel that there's a connection, that they understand that I understand what it is that they're doing. So I would say that those are the sort of the common denominators. They tend to be high Sharpe ratio managers. They understand that to get a return, you're taking risk. Return costs something. And that's the definition of a Sharpe ratio, that for a unit of return, there is a unit of risk, and that's the volatility. Now, we like Sortino ratio better because you're not penalized for having upside volatility, only for downside volatility. But when your return doesn't cost me a lot, like a managed futures manager might have a Sharpe ratio of less than 1. Why? Because their returns are like this. You may end up being up here, but it could easily have been down here. That's not an attractive strategy. I don't care how much I like the guy. That's not an attractive strategy for us.
Hey, Tom, that was fantastic. I learned so much. So this is a beautiful model. I really like it. I wish you all the best and look forward to stay in touch.
Listen, thank you so much for inviting me today. It's really been a pleasure to share with you the Lucidity business model and some of my history. And thank you for such a wonderful platform.